Welcome to Unpack Your Financial Baggage, where we help you answer one simple question. Will you outlive your money, or will your money outlive you? Here are your hosts, certified financial planner and managing partner of Melone Private Wealth, Lou Melone, and editor of D Business Magazine, RJ King.
Well, it's great to see you, Lou.
Thanks. It's nice to see you, RJ, and we have Branden here as well.
Yeah, thanks for having me. It's good to be here.
Great to see you, Branden. Well, today we're going to talk about the mistakes people make regarding the 9 behaviors in behavioral finance. Perhaps a better term would be the nightmare of mistakes people make and what it can potentially cost them.
Well, yeah, unfortunately, we hear about these situations when we're talking to either business owners and families in different gatherings. In addition, we're continuously explaining behavioral investing when meeting with our clients for either reviews or our monthly communications. It's really a never-ending process, acting as their behavioral coach to hopefully avoid any of these traps.
Not only are there traps, to fall into, but it's really incredibly easy to do so. It doesn't really matter how smart or level-headed you may think you are. Mistakes get made. It's part of human nature. In many situations, we're actually wired to fall into these traps. As we discussed in prior podcasts, this wiring often goes back thousands of years. And at one point, it was actually useful.
Well, that's a great intro. Let's look at the 9 behaviors, how people fall into the traps and how to avoid them. The 9 behaviors are loss aversion, narrow framing, mental accounting, diversification, anchoring, optimism, media response, regret, and hurting. Just hearing the list, I can tell you that the behavioral lessons we'll learn today can likely be applied to other parts of life besides investing. So let's start with loss aversion. What is loss aversion, Lou?
Well, simply put, it's the fear of losing $100 is mentally more painful than the hope of gaining $150. So you can test yourself on your level of loss aversion in this way is, what's the smallest level of gain you require to balance out an equal chance to lose $100? So studies have found that to most people, that amount is $200, which obviously is twice as much.
So I understand the concept and can relate to it, but when you put it in those terms, I guess I don't understand why we keep falling into the loss aversion trap. It must be rooted in people on some kind of deep level. Is loss aversion useful as a behavior at all? And where is this coming from?
Psychologists point to how our brains are wired. And over the course of our evolution, our evolutionary history, protecting against losses has been more advantageous for survival than really seeking gains. In addition, we're socially conditioned to fear losing in just about everything from money to sports to board games. As a side note, loss aversion is very similar to another cognitive bias called the endowment effect, which is people tend to assign higher values to things they already own compared to equal items that they don't own. So essentially, individuals often overvalue the things they have just because they have them, regardless of their objective market value.
I suppose then this behavior could be handy if we were still living in caves. How can we avoid loss aversion, Branden?
Yeah, like you said, RJ, if we were still living in caves, loss aversion would be a useful behavior, meaning the fear of being eaten by a, let's say, saber-toothed tiger is better for survival than picking a berry from a plant in the Sahara. Unfortunately, this fight or flight part of the brain makes us all, absolutely terrible investors. And we've carried that kind of fear with us for thousands of years. Let's say, in our current environment, this fear can impact how we experience losses as simple as viewing our monthly statements, when it comes to our investments. For example, for many people, seeing a temporary loss on their statements triggers that same fear mechanism. Then this perceived pain starts to influence decision-making, as people seek to avoid that pain. Their brain believes avoiding loss equals avoiding pain. As a result, the pain of loss steers them into becoming much more conservative in their decision-making. However, by trying to avoid the loss, and making overly conservative decisions, the investor may make worse decisions because they become paralyzed by the volatility of the markets. Remembering that perceived loss can't be differentiated from a real loss by the human body, causing the body to send signals to part of the brain to avoid loss at really all costs. Going back to the example of the monthly statements, how do most investors define loss? By the day-to-day volatility that we all see in the markets and what they have historically provided, which is really incorrect, but that's how it works. One of the solutions is, and this will be a recurring theme that Lou and I will both bring up here, is get a financial behavior coach. Financial planner acting as a behavior coach can help you refocus the brain on your plan, the things that are most important to you. And as most areas, sometimes thinking rationally requires a coach.
Oh, that's great advice, Branden. Let's now talk about narrow framing. I believe the concept starts with making decisions without considering all the implications. Lou, what's an example of where people fall into this behavioral investing trap?
To expand a little bit on that concept, narrow framing explains that individuals usually make decisions based on how an issue is presented, or what we'd call framed, rather than on the facts that are actually presented. So it's a cognitive shortcut to choose an option that's more positively presented or framed. So one way to think about narrow framing is in a sales tactic that is used all the time. The perception in which the price of a particular item is seen to be better with a dollar-based discount. For example, $200 versus 20%.
Right. I've seen this tactic day in and day out, especially on appliances and computers. But when it comes to investing, how do people find themselves impacted by narrow framing?
Well, narrow framing can come into play regarding investment products, and those products being sold by brokers, insurance agents. The best example is annuities. Agree or disagree with annuities, the way that they're framed can seem irresistible to people. For example, people hear the following commercials about annuities like help build a guaranteed income stream or retirement nest egg. It's like being able to create your own pension fund. The other one is and investors who are seeking stable, guaranteed lifetime income and protecting you when the markets go down. So when you hear words like stable, guaranteed lifetime income or guaranteed investment stream, protection when the market goes down, it can be very difficult for human nature to turn down that annuity.
I would think so. Usually you hear phrases like past performance is no guarantee of future success, and there are no guarantees when it comes to investments. But are annuities everything they promise?
Well, let's stick to this idea of narrow framing first. So as you can see, the way these products are framed, they're very appealing, right? So annuities, however, they shouldn't be judged as a standalone solution. So any financial plan should be based on retirement goals and the incomes needed for retirement. So the entirety of the question one should ask when talking about these annuities are, will annuities supply the amount of income you need to live throughout your retirement years? And do you know how much money you need to live the lifestyle you want to live? And also, how do they measure up against other strategies in a 20 or 30-year retirement plan, which is important, after the expenses that are built in for these guarantees that they're offering? So these are the questions to ask when you see guarantees being made. And as we're all aware, insurance companies aren't providing these bells and whistles for free.
I see. Sometimes, as they say, if it sounds too good to be true, then it's just maybe too good to be true. So I can see how it's easy to present concepts using narrow framing that may be harmful to a retirement plan. How can people avoid narrow framing?
Yeah, I can jump in on this one. This behavioral investing trap, as Lou was kind of just explaining, is one where education and, actually understanding investment concepts like retirement income is important. Having a financial planner acting as that coach, as I said earlier, will allow you to see how opportunities are being framed. Also, keeping a long-term view, knowing that you'll have a financial plan that's being designed with your retirement goals in mind, is probably the most important way to avoid this behavioral concept of narrow framing.
Well, the next behavioral investing topic is one that I'm guessing everyone has absolutely found themselves struggling with numerous times: mental accounting. I think at almost every stage of life, we've battled mental accounting, from a piggy bank to a vacation fund to credit cards. Mental accounting makes us see differences that don't exist. Branden, could you kind of elaborate on that?
Yeah, absolutely. Most people assign subjective value to money, usually based on where it came from and how it's intended to be used. While that approach may sound harmless and reasonable, it can actually work against us and leave us economically worse off. Although every physical dollar is the same, we mentally attach a different value on each dollar, based on how it was acquired. Mental accounting is a physical connection between acquiring a dollar and the spending of that dollar. It's really why many people go bankrupt, after winning the lottery. If you want to get more into the details of mental accounting, when you get up, go to work and earn a dollar, then the pain associated with actually spending that, quote unquote work dollar becomes much more painful. So in turn, most tend to spend that dollar a little bit more carefully. However, if you kind of flip that, when you're given a dollar as a bonus, tax refund, or like I said earlier, you win the lottery, then you don't think of this dollar as actually earned. As a result, you spend that dollar differently.
Well, for many people, including myself, I would guess seeing an actual dollar leave the wallet is more painful than spending a dollar via a credit card.
Hey, RJ, before we touch on the credit card, I'd like to add one more concept about Branden's explanation of when we call given free money and how it's spent. So let's say consider how politicians spend money. Do you believe it's viewed as earned or free? I would guess there's not much pain attached. So just imagine how it would be spent if they actually earned it. Anyway, sorry, back to the original question. So yes, credit cards impact people in that way. So we often see that people spend more using credit cards than cash. So this is because the pain of paying theory, a plastic credit card is less tangible than cash because one can't visibly see the loss in money through the swipe, again, of a card. And obviously the payment, remember, it's deferred. You get it at the end of the month. So this is why Vegas encourages credit cards, playing chips, and the sort, because it's difficult to remember you're spending your money when it's that swipe of a card, and therefore it's just less painful. So again, it's not the same pain as pulling a physical dollar out of the wallet or the purse, so to say. And as a simple example of emotional attachment, there actually was an interesting study regarding trying to help lower income families spend less. So what they did is the families put dollars in different envelopes and then put pictures of their children on the envelope so they would then save more. Why? Well, there was now an emotional attachment to those dollars. So when you start with the concept Branden explained, which is there are different values that a person places on the same amount of money, again, based on the pain of spending it, you can see how easy it is to get into financial trouble. And you don't even realize you're hardwired to do so.
So how can we avoid mental accounting? I don't want to hope that I don't win the lottery, or I don't want to hope that I don't get a bonus.
Right. Absolutely. So it's not easy, but start with the idea that money is completely interchangeable, no matter how you spend it or earn it. So each dollar is valuable. It's not an easy process, but trying to imagine that every dollar is earned, earned. So would you pay for the same item if pulling out of cash or writing the check?
Great explanation. Let's move on to diversification. Generally, we hear only good things regarding diversification. We're told to have a diverse portfolio. Branden, how can diversity be a bad thing?
Yeah, well, like you said, diversification usually is generally a good thing, right? We want to have it in our portfolios, but the idea of diversification can actually be deceptive. Let's say if you believe diversification, for example, that it's owning multiple companies' stock in one industry means you're diversified. However, all those investments are actually exposed to the same fluctuations of that industry. So simply put, diversity through one industry is not diversity.
Yeah, exactly. And I'll chime in here. Think about it. Obviously, we're here living in Michigan. So essentially home of the big three. I've come across this many times from those that work in the auto industry. To compound the issue, they not only work in the auto industry, so their income, their health benefits, their pensions, the entire plan would be tied to one industry. It's been, I think, a harmless mistake, but one that could, now it did back, if we remember, GM declared bankruptcy during the Great Recession, but it's one that could blow up their entire retirement.
Wow. So diversification isn't defined as having different stocks, because different stocks in the same industry really expose you to the risk in that industry. You've essentially concentrated your risk into an industry by owning what you think is a diversity of, say, auto stocks. I can see how that kind of diversification can be bad. But Branden, I'm sure there's other ways.
Yeah. Actually, the author Nick Murray provided the definition of diversification as, I'll never own enough of any one thing to make a killing in it, and I'll never own enough of one thing to get killed by it.
So what's the proper way to diversify, Branden?
The way we approach it with every single one of our clients, we call it the bucket approach, and it should be always tied back to, again, your comprehensive plan. This may sound like common sense, but the average investor places the cart in front of the horse, partially driven by brokers, insurance agents in our industry.
What do you mean by that, Branden?
Well, in the nicest way, many advisors, quote unquote advisors in our industry, don't actually provide comprehensive planning. They may say they do. Unfortunately, many don't. What they really are providing is asset management. There's nothing wrong with this, but they hide behind the cloak of planning when in actuality, they're just looking to bring in more assets to get paid more.
Yeah, I mean, quite honestly, this is what normally happens. Branden's being pretty nice and polite here, but what's tricky for the client is that they believe, right, they're getting planning advice. When the broker throws something that looks like a plan in front of them, right, but it's only the carrot to get those assets. What ends up happening in all reality is that so-called plan is never looked at again if they become a client.
So constant review is a key here. Let's move on to anchoring. It's another concept that not only may impact your retirement plan, but how people see retail shopping and other areas of their life.
Yeah, the definition of anchoring is when we take the familiar and extend those concepts in ways we probably shouldn't and aren't appropriate. So, let's talk about geese for a minute.
Geese?
Yeah, actually, RJ, we're going to talk a little bit about geese. So, in a study, a scientist removed multiple eggs from a goose's nest. All right, so when the eggs hatched, the scientist, was looked at as the parent as they saw, while the other geese from the remaining eggs knew only their biological parent. So the fascinating aspect of this was that the scientists, the goslings, actually followed him around as if it were completely natural. Then he mixed all the geese back up again, the goslings. They would reroute themselves back to their, what we would call, I guess, the identified parents when they hatched, and he called this imprinting. However, in humans, scientists call this anchoring.
And how does that relate to human behavior, Lou?
Well, it's fascinating because the scientist states that, think about it, we're all bombarded in life by prices, right? So including, call it suggested manufacturers' retail prices for purchases like cars or lawnmowers. Maybe it's local housing prices of newer used homes. He states that these are not necessarily anchors to begin with, but they become anchors in our minds once we contemplate purchasing one of those items. This is when the anchor, or again, they call imprinting, sets itself into our mind in the decision-making process. So then our mind subconsciously refers to that original anchor. And presto, RJ, you're now Gosling.
Well, I didn't think geese would come up today, but it makes sense, though. Through behavioral investing, we can learn a lot about how we may be manipulated by sales tactics or just our own brain. But most importantly, I think the lessons are on how to avoid this behavior when it comes to your long-term financial plan. Is that right, Branden?
Yeah, you got to understand that people can be tied to their first impressions, as Lou was just saying. They may be overly anchored to facts and figures that aren't necessarily relevant. As an example, when you look at investing, the initial investment amount may be used to compare all future gains and losses of that portfolio, reinforcing how much future dollars will be invested, meaning, the money that gets invested initially, the market, let's say, temporarily pulls back, which is normal and natural. But now the investor stops investing as they're anchored, to that initial amount. And now it's lower. They hold off, due to loss aversion, when in reality, now they should be adding more at better prices, especially if they're a long-term investor. Really the best way to avoid this, again, kind of hammering this home, but it's simple. Have a plan. Anchor all investments, any future investments to a long-term strategic plan, that's based off of your goals and is really created by a certified financial planner who understands the true fundamentals of retirement planning.
Okay, great. Well, let's move on to optimism. How can optimism be bad? Haven't we always been told to be optimistic, stay positive, don't dwell on the negative, and move forward, and the other 10,000 cliches that come with it? Branden, how can being optimistic be negative?
Well, similar to when we were talking about, diversification, there's actually a kind of a bad way to look at being a quote optimist. Consider we're talking about optimism as a belief that good things happen to me and bad things happen to others. It can be easy to see how quickly your financial plan can go off the rails with that type of outlook. The saying by author Morgan Housel is to save like a pessimist and invest like an optimist.
Well, with that type of definition, I suppose bad decisions may be made easily.
Yeah, sure. Absolutely. So, think of it this way. When you believe good things happen to you and you can't be impacted by all the bad things that other people experience, then yes, you believe that your investing choices will always be correct or just eventually work out. The real issue is when that optimism borders on overconfidence, and we've all met these type of individuals. So they're always certain it will work out. Well, I guess until it doesn't. But if you think about it, if even Warren Buffett or the Warren Buffetts of the world make wrong decisions and must adjust. So not just be optimistic that they're going to work. So once again, the solution is to have a plan, a behavioral coach, and meeting with them to update your plan, important, annually. So by doing so, optimism can then be reshaped, what I would call to realism, as life events change.
Well, the concept of having a plan seems to be the common theme with getting past what human nature has embedded in our brains. Perhaps the most unavoidable behavior is media response. It's virtually impossible to tune out the media unless we go back to that example earlier of living in a cave with no Wi-Fi. What do you think, Branden?
Yeah, it definitely can be, like you said, especially with everything really right at our fingertips. But, if you look at it from a technical definition, it's really a tendency to react to news without reasonable examination. And we see this, and I'm sure you've seen this on a day-to-day basis. If you look at it from like a daily routine standpoint, you go to work and Today you're feeling uneasy about your job status. You watch the news or read the newspaper if people still do that now. And the news explains the financial markets are tanking. Commercial then explains gold is a safe haven for your money. You go home, have a restless night's sleep because of all this worry, and you wake up at 6 a.m. and wait until your financial planner gets into the office at 8, or you wake up and start buying gold. Panic all day, and then sure enough, you turn on the news and learn the tech sector is red hot. Then you just go back and repeat those prior steps, buying into the tech sector. You can also really replace, the first thing I said with, anything going on in your life. It might not be unease about your job status. It could be unease about the economy or elections or any end of the world event that financial media is really spewing in that moment.
You're so right. And what you're explaining is common, I think, for most people. After reading a headline or an article, investors tend to be influenced by those headlines and react quickly to the news. It's kind of natural, right, Lou?
Yeah, absolutely. If you don't have a long-term plan that's built for your lifetime, then watching the news can be a roller coaster of emotions, which then manifests into your new plan. As a reminder from prior podcasts, the financial media is not your friend. Although they do a good job of making you believe they're keeping you informed about what is important for you, nothing can be further from the truth. By the way, RJ, this does not include you or anything at D-Business, because I know you provide more detail of just businesses in general.
Oh, thanks, Lou. That's much appreciated. Our focus is on what's happening to businesses and those people in the Detroit area, those business leaders. Now, what about regret? We've all experienced regret, but when we think about regret, it's often seen as a positive reaction from which we can learn and move forward. We're told that it's okay to have regrets because we can reflect on what we've done. So business calls it fail fast and have no regret. Sounds easy. Lou, tell us about regret and behavioral investing.
Sure. RJ, the simple view of regret is that people treat what we call errors of commission more seriously than errors of omission. Regret often refers to human behavior regarding the fear of regret, which stems from people anticipating regret if they make the wrong choice. It also impacts investors because it can either cause them to be unnecessarily risk adverse, or it can motivate them to take risks that they shouldn't. So when it comes to retirement plans, regret can factor into something as simple as, but a very important planning tool, meaning rebalancing, right? The tool of rebalancing a portfolio. So people often ask themselves, what if I would have just let my winners run? Meaning you may regret it if the investment you own continues to go up after you sold it, or reduce the amount in it to rebalance that portfolio, even though in the long run, this rebalancing has been proven to increase an investor's long-term return. So this normally happens when an asset class gets to, I would call, extreme levels, or what we call bubbles. Prime example, I recall, was in 1999, 2000, during the dot-com bubble, or you could even go back as recently as the 2007 to 2009 housing bubble, right? The Great Recession. In both, the fear of regret was too strong for those to rebalance, again, in the dot-com era, or to sell to deleverage during the housing bubble. And how'd that turn out for most?
Not very good.
Yeah, RJ, you're being kind. It was a disaster for a large majority of individuals, both believing that prices were going to continue to go to the moon until, of course, they don't.
Yes, I was a bit kind there. Branden, how can we course correct and avoid that regret?
To avoid, this constant state of regret, once again, working with a behavioral financial coach, have a plan. And when you talk with your planner, really discuss that plan. Understand how it was built for your long-term goals. Although not every financial planner is a good match for every person, if you can find that planner you're comfortable with on all levels, you have, higher probability to actually manage that regret. It's about having the trust in the advisor and the plan you've built.
relationships matter, and trust is so essential to any kind of a financial relationship. I suppose people need to look at how regret has impacted their decisions in the past and take that into account when considering a new opportunity. Now let's talk about the ninth and last of our behaviors, herding. This one sounds like everything from peer pressure to mob mentality and one for the pitchforks and the torches crowd. Branden, why don't you start with this one?
Yeah, absolutely. When we view herding as copying the behavior of others, even in the face, let's say, of unfavorable outcomes. Simply put, like you said, going with the crowd. It can get you into trouble because you're assuming things are good or bad only because others are doing the same. Again, this Lou just brought up, the .com bubble is a prime example of the effects of that herd instinct. Also, a study published in Behavioral Ecology and Planet Earth revealed that, people are actually 1.5 to 2.5 times more likely to, let's say, cross a busy road if the pedestrian next to them, sets off first. Now, this doesn't just apply to crosswalks. Humans are natural followers and, often act similarly with their investments and their money. Whether it's fear of missing out on the next big stock or pulling out of their investments, regardless of rational data supporting the opposite.
Right. It's an instinct that's a trap at all ages for so many reasons. We see it all the time. Lou, how do we steer clear of this herd mentality?
Well, in the simplest form, I would just say, go your own way by following your plan. However, the reality is that peer pressure and going with the crowd are instinctual to human nature. Because it's instinctual, those who don't succumb to it can often feel distressed or even fearful. So going back to, as we mentioned earlier, our evolutionary history, there was strength in numbers, and following the crowd provided protection and actually a level of comfort. So if the herd is going in one direction, an individual may feel they're wrong by going the opposite way, and they may fear being singled out for not jumping on the bandwagon. Again, historically, this is how mobs with pitchforks formed. To help beat back that mob mentality, your behavioral financial coach really can help you steer clear of the herd by refocusing. And I think that's important, is just refocusing you back to your long-term plan. And in my experience, the herd is always wrong long-term.
So avoid the herd. Seems simple enough. Now, today we've covered 9 behavioral investing mistakes people should avoid. We've demonstrated these behaviors with specific examples of where people have made mistakes. The best way to avoid these behaviors could be to hire a financial planner you can trust and who acts as your behavioral coach. Sometimes it's too difficult to go it alone with the stakes so incredibly high. I mean, we're talking about your retirement lifestyle. It may be best to hire a financial planner, build a long-term plan, and listen to your coach.
Hey, RJ, couldn't agree with you more.
Well, thanks, Lou. Branden, what's our next podcast?
Yeah, speaking of having that financial coach, we're going to discuss really the role of the financial advisor as a quarterback, for the client. We'll talk about how the financial advisor really fulfills that leadership role of that financial planning team. We'll review the other team members someone may want to have on their financial planning team, how often the team should meet, what the team reviews with the client, and how to assemble your team. For many people, this is really a new way to see financial planning. So we will review the history of our industry as well, from stockbrokers to traders to large investment houses, and how many people think they may be engaged in financial planning as they try to day trade their way to riches.
Oh, that sounds great. I mean, very interesting, and I can't wait for our next discussion.
The information provided is for educational, informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based on certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such. Melone Private Wealth LLC, MPW, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where MPW and its representatives are properly licensed or exempt from licensure. No investment strategy or risk management technique can guarantee returns or eliminate risk in any market environment. All investments include a risk of loss that clients should be prepared to bear. The principal risks of MPW strategies are disclosed in the publicly available Form ADV Part 2A. Generally, among asset classes, stocks are more volatile than bonds or short-term instruments. Government bonds and corporate bonds have more moderate short-term price fluctuations than stocks, but provide lower potential long-term returns. U.S. Treasury bills maintain a stable value if held to maturity, but returns are generally only slightly above the inflation rate. This has been the Unpack Your Financial Baggage podcast. Feel free to share this episode with someone you think it may benefit. You can also follow our show on Apple Podcasts, Spotify, or wherever you're listening right now. To learn more about Melone Private Wealth, visit MalonePrivateWealth.com. The Unpack Your Financial Baggage podcast is produced by Jag and Detroit Podcasts.